In US enterprise environments, many finance teams model AI deployment as a stabilizer for reported gross margins. A customer support automation initiative lowers labor cost per transaction, and the forecast assumes the quarterly margin line will move more smoothly with revenue. Yet after scaling, several companies report the opposite. Average margins rise, but quarter-to-quarter movement increases. This raises a precise capital question. When AI improves average margin, does it reduce or increase the volatility of reported margins across reporting periods under live US market conditions? The prevailing assumption is that converting labor cost into scalable inference cost will compress variability and produce steadier margins. This holds for average cost, but not for variance. The new layer introduces sensitivity to utilization spikes that trigger higher cost routing, quality requirements that force escalation, compute rate movements, and competitive response timing. What registers as margin improvement in the mean often registers as greater quarter-to-quarter dispersion in the P and L. Consider this relationship sketch of the margin stack. Legacy gross margin rests on allocated fixed costs and a contained variable layer. AI overlays a distinct variable band whose width depends on transaction volume and model routing. The upper edge moves with utilization and quality thresholds. The net margin line therefore acquires additional slope and inflection points that legacy allocation had smoothed across periods. This added sensitivity stays masked in pilot phases. Volumes are capped, exception handling is absorbed elsewhere, and routing stays simple. The first reporting periods show margin expansion with limited visible variance. Once the system runs at production scale under variable demand, the width of the new band appears in contribution margin variance and in the frequency of guidance adjustments. The margin gain from labor displacement holds only while inference cost per transaction remains both predictable and stable across the actual range of utilization the business experiences. Quarterly reporting pressure turns moderate variance into guidance risk. When utilization exceeds the modeled band, higher cost routing or quality-triggered escalation can push period costs above plan faster than revenue scales. When utilization falls, committed elements prevent costs from declining proportionally. The result is greater quarter-to-quarter movement around the new average. Competitive timing adds further reporting sensitivity. When AI enables cost reduction, rivals move to match efficiency. Once they do, the first mover's pricing power often softens within a small number of reporting cycles. Revenue per unit declines, while the new cost layer remains exposed to volume and routing variability. Internal savings persist, yet reported margins move more sharply than before. The reduction in direct labor cost registers clearly after deployment, yet the combination of usage-linked inference costs, model refresh timing, quality-triggered escalation, and competitive response timing means gross margin now responds to a wider set of operational and market variables. The volatility is not temporary friction. It is inherent to the cost architecture once operating without the buffers of low initial utilization or first-mover pricing advantage. What had been a relatively stable margin series becomes one whose dispersion is shaped by utilization bands, routing mix, and the speed of competitive imitation. The reported margin line therefore moves with variables that legacy cost structures had largely internalized. Finance teams that have observed this pattern have moved from single-point margin forecasts to explicit variance ranges. They now test utilization bands, routing thresholds, and competitive response timing, then track the resulting spread of gross margin outcomes. the central question shifts from whether average margin improved to whether the margin series itself became more or less stable under live conditions. Legacy integration adds another source of reporting volatility. When AI capabilities sit alongside existing platforms, reallocation of supporting costs often occurs in discrete steps rather than smoothly. Interim margins therefore mask the true period-to-period movement of the AI-enabled offering. When the reallocation lands, it registers as a step change in reported margins, amplifying the dispersion the model was meant to stabilize. The economics produce lower margin dispersion when AI is applied to high-volume, low-complexity processes where query patterns are stationary and utilization stays inside a narrow, forecastable band. Dispersion increases when AI is applied to variable demand or judgment-heavy processes where escalation rates and routing needs fluctuate with customer mix. In those settings, the new cost layer introduces variance that legacy labor had absorbed less visibly. Margin expansion observed under pilot conditions therefore narrows instability once three boundary conditions are tested at scale. Utilization must remain inside a band narrow enough to limit routing changes and quality escalation. The AI offering must retain enough differentiation to slow competitive price responses, and residual oversight must not scale in ways that amplify period-to-period swings. Weakening any condition increases dispersion relative to the pre-AI baseline. The advantage, therefore, remains conditional on keeping all three variables within controlled reporting ranges. Organizations observe these boundaries through cohort contributions margin analysis and sensitivity modeling that varies utilization, competitive response lag, and model refresh frequency. The relevant test is whether the margin series shows lower or higher dispersion once running under live market and allocation conditions. Where dispersion rises, capital planning requires wider confidence intervals around margin guidance and greater operating budget contingency. Returning to the margin stack sketched earlier, the added AI cost band does not flatten automatically with scale. Its sensitivity to volume, routing, rate changes, and quality thresholds determines whether reported margins stabilize at a higher level or continue to move quarter to quarter. In AI markets, the question is not only whether margins rise, but whether the new margin level can hold still